Ma'am, there appears to be a hold on your account. 7 words. 7 words spoken by a young woman behind a bank counter to a 69-year-old retired school teacher named Eleanor Whitfield on a perfectly ordinary Friday morning in February of 2026. Eleanor had walked into her neighborhood bank in Tampa, Florida, the same bank she had used since 1978, holding her grocery list in one hand and her grandson Tommy's birthday card in the other, planning to withdraw $200 in cash to cover her weekly expenses. The same $200 she had withdrawn on the same day of the week for the past 11 years, without a single problem, without a single question, without a single moment of doubt that the money would be there waiting for her, because it always had been. She never got the $200. She never got the groceries. She never mailed Tommy's birthday card on time. She walked back out to her car, sat down in the driver's seat for 19 minutes without turning the key, and tried to understand how a woman who had never bounced a check in 47 years of careful, responsible, disciplined financial living had just been locked out of her own life savings by a teller who looked apologetic but had no further explanation to offer beyond those 7 words and a toll-free number printed on a small white card. And here is the part that should make every single senior watching this video sit up straight in their chair and give this their full, undivided attention. Eleanor did not do anything wrong. She did not commit a crime. She did not miss a tax payment. She did not fail to report income. She did not write a bad check, overdraw her account, violate a banking regulation, or even argue with anyone in the building. She simply walked in to withdraw money that was entirely and unquestionably hers. Money she had saved over decades of working in a public school classroom. Money she had earned one paycheck at a time. And she was turned away because a computer in a windowless data center in suburban Maryland, an automated monitoring engine that did not even exist 18 months ago, looked at Eleanor's checking account balance, compared it to her most recent tax return, and made a decision in under 90 seconds. That decision froze her money. That decision sent her home without her groceries. That decision left a 69-year-old retired school teacher sitting in a parking lot, trying to understand something no one had ever warned her could happen. I am telling you right now, on my reputation, that if you do not stay with me until the very last second of this video, the very next time you log into your banking app or walk into your local branch, you may discover that you have lost access to your own savings. Not because you stole anything, not because you owe anything, not because you did anything that any reasonable person would describe as wrong or suspicious or improper, but because the federal government's new automated monitoring system has decided that your account balance does not match what their algorithm believes it should look like based on your reported income. And it has acted on that conclusion without asking you a single question. There is one specific dollar amount, and I am going to name it before this video ends. An amount that millions of seniors across this country are keeping in their checking accounts right now, as you sit here watching this, that places them directly in the crosshairs of the most aggressive, most comprehensive, most far-reaching financial surveillance system ever turned against ordinary American citizens. That amount is coming. Stay with me, because at the 8-minute mark of this video, I am also going to reveal the hidden connection between a frozen bank account and your Medicare Part B premium. A connection that could permanently increase what you pay for your health care every single month for the remainder of your life. And once that penalty is locked in, once that clock runs out, there is no appeal, no waiver, no exception. No supervisor you can call and no form you can file to undo it. Let me tell you in one sentence why 2026 is fundamentally different from every year that came before it for American retirees managing their finances. In 2022, Congress quietly handed the Internal Revenue Service the largest single funding increase in that agency's 80-year history, billions of dollars. And the agency did not spend the majority of that money on hiring additional human auditors to sit at desks and review paper returns. It spent that money on machines, on artificial intelligence systems, on cross-referencing software, on real-time automated monitoring engines that connect your bank deposits to your tax filings, to your Social Security records, to your Medicare enrollment information, all stitched together into a single unified surveillance infrastructure that watches every dollar that enters or leaves your bank account every minute of every business day, without rest, without error, and without any human being making a judgment call before a flag is triggered and action is taken. And here's the part that almost no senior in America currently understands. The part that nobody at your bank will volunteer to explain to you when you come in on a Friday morning to withdraw $200. Your bank, that warm, friendly, familiar community bank you have trusted for 30 or 40 years, the institution whose tellers know your name and whose branch manager sent you a birthday card last October, is legally required by federal law to feed your complete transaction data into this federal monitoring system. The teller does not ask your permission before that data is transmitted. The branch manager does not call you to let you know what is happening. There is no opt out form. There is no notification. The data flows silently, automatically, every single business day, directly into federal hands. And your knowledge of that process is entirely irrelevant to whether it continues. So here is the question I want you to keep at the very front of your mind for the next several minutes. How much money is safe to keep in a checking account in 2026? The honest answer, the one no financial advisor who appears on television will ever tell you plainly, because the banks those advisors advertise for profit directly from the size of your deposits, is that the specific dollar amount matters significantly less than the pattern your account creates over time. The federal monitoring system does not simply look at a single balance on a single day. It watches the movement. It watches the timing. It watches the relationship between what comes in and what goes out. And it watches for 5 specific trigger patterns, 5 electronic tripwires buried inside the normal activity of a checking account that can cause your money to be frozen without warning and without explanation. I am going to walk you through every single one of those 5 tripwires right now, because every senior watching this video tonight needs to understand exactly which tripwire they are currently sitting closest to and what they can do before the wire is triggered. Here is the first trap, and it is the exact trap that caught Eleanor Whitfield on that Friday morning in Tampa. Banking compliance professionals call it the balance to income mismatch flag. The federal monitoring system has built, for every single American who holds a bank account and files a tax return, a mathematical profile of what that person's checking account balance should look like on any given day, based on their reported annual income, their known fixed expenses, their Social Security payment schedule, and any pension or retirement distribution patterns that appear on their returns. For a retiree receiving $2,400 a month in Social Security benefits and another $1,400 a month from a pension, the system expects to see a checking account balance that fluctuates somewhere within a predictable range, typically between $3,000 and $4,000, moving up when payments arrive and down as bills are paid. When that balance suddenly rises to $15,000 or $20,000 or $30,000 and stays there for any meaningful period of time, the system does not stop to consider that perhaps you sold your late husband's antique pocket watch collection at auction and deposited the proceeds. It does not assume that your sister in Cleveland passed away last spring and left you a small inheritance that has not yet been dispersed to the other heirs. It does not pause to wonder whether you simply had an unusually low expense month and the money accumulated naturally. It identifies a statistical discrepancy between your balance and your income profile, and it acts on that discrepancy. The flag fires. The data is forwarded. A hold can be placed on your account within 48 to 72 hours of the flag triggering, before any human being has reviewed your situation, before any letter has been sent to your address, before anyone has given you any opportunity whatsoever to explain where the money came from. Now, here is the second trap, and this one carries consequences so severe that I need you to hear every word of this before I move on, because this trap has a body count measured in destroyed retirements, bankrupted families, and life savings permanently seized by the federal government from people who never intended to break a single law. It is called the structured deposit pattern. Under federal law, specifically Title 31 of the United States Code, Section 5324, it is a federal felony, punishable by up to 5 years in federal prison and a fine of up to $250,000, to structure deposits or withdrawals for the purpose of avoiding the $10,000 mandatory bank reporting threshold. Banks are required by law to file a currency transaction report with the federal government for any cash transaction of $10,000 or more. Most people know this. What most people do not know is the part that makes this trap so extraordinarily vicious. The federal government does not need to prove that you knew the $10,000 rule existed. They do not need to prove that you understood you were doing anything wrong. They only need to demonstrate that the pattern of your transactions, the timing, the amounts, the regularity, reasonably suggests that those transactions were structured to remain below the reporting threshold. The intent does not need to be proven beyond a reasonable doubt in the way most people imagine. The pattern itself is treated as evidence. Let me give you a real name so that this does not remain an abstract legal concept. Randy Sowers was a dairy farmer in Maryland who spent 30 years raising cows, producing glass-bottled milk, and selling homemade ice cream at farmers markets across his county, where customers paid for their purchases in cash, the way farmers market customers have paid for generations. A bank teller, attempting to be helpful, told Randy's wife Karen that keeping their cash deposits under $10,000 would save the bank some paperwork and simplify the reporting process. The teller meant well. The teller never mentioned that structuring deposits to stay below $10,000 was a federal felony. Karen Sowers followed what she understood to be reasonable banking advice from a person she trusted. In February of 2012, the IRS seized nearly $63,000 from the Sowers family checking account, the entirety of their accumulated savings. Federal prosecutors threatened Randy Sowers with 5 years in federal prison for depositing his own milk money in the manner his bank teller had suggested. The Sowers family eventually agreed to forfeit $29,500 of the seized funds because they could not afford the legal fees required to fight a prolonged federal prosecution, even though they were innocent of any criminal intent and had done nothing more than follow advice from a trusted banking professional. A dairy farmer who spent 30 years building a legitimate small business lost $29,000 because a bank teller gave well-intentioned but catastrophically incorrect advice. That is the structuring trap. It is not historical. It is operational tonight, in the current monitoring environment, under intensified scrutiny. But I have not yet told you about the trap that hit Eleanor Whitfield directly. Stay with me, because this third trap is the one that most seniors watching this video have unknowingly triggered within the past 12 months, and they do not yet know it. Picture this scenario carefully, because it is happening right now, in real time, to real people across every state in this country. You wake up one Tuesday morning in the spring of 2025. You walk to your mailbox and you find a check from the Social Security Administration. It is a retroactive payment resulting from the Social Security Fairness Act, passed in late 2024, a piece of legislation that eliminated long-standing reductions for retirees who also received pension income from certain government jobs. For some retirees, that retroactive check is $6,000. For others, depending on the number of years affected and the size of their previous reduction, the check is $11,000 or more. You take that check to your neighborhood bank, the same bank you have trusted for decades, and you deposit it into your checking account, because that is where your money goes. And in that precise moment, while you are still feeling a warm sense of relief and gratitude that the government finally corrected something that had shortchanged you for years, you have unknowingly walked directly into the third trap. The federal monitoring system cross-references every deposit above a certain threshold against your most recent tax return. When a deposit appears in your account that does not match any reported income source on that return, the system registers a discrepancy and fires a flag. And here is what makes this situation so particularly cruel. The deposits that are triggering this flag, right now, today, at this very moment, for thousands of seniors across this country, are almost without exception completely legal deposits of money that belongs entirely and unquestionably to the person receiving it. Fairness Act retroactive payments are legal. Inheritance funds received after the death of a spouse or sibling are legal. Home sale proceeds from a downsizing move are legal. Insurance payouts received following a hospitalization or accident are legal. Class action settlement checks from a lawsuit you were part of years ago are legal. Every single category of deposit I just named is legal. Every single one represents money that is entirely yours. But every single one creates a discrepancy flag that the automated monitoring system cannot distinguish from unreported income from an unknown source, and it responds accordingly without asking you to clarify. The fourth trap shows up most commonly on the accounts of seniors who regularly send money to family members living in other countries. The international wire transfer flag has expanded dramatically in scope and sensitivity in 2026. The threshold for triggering an automatic flag on international transfers has dropped significantly below the historical $10,000 line that most people associate with federal reporting requirements. Transfers of considerably smaller amounts to certain designated countries can now trigger an automatic flag regardless of the dollar amount involved, based solely on the destination. A grandmother sending $2,000 to help her grandson with tuition while he studies in London is not breaking any law. A widow sending $1,500 each month to support her elderly mother who lives in another country is not engaged in any form of criminal activity. But the monitoring system does not pause to consider family relationships, compassionate circumstances, or the entirely lawful nature of the transfers. The flag fires automatically. The data is forwarded to the Financial Crimes Enforcement Network, commonly known as FinCEN. And if the senior's tax return does not include the required disclosure forms for foreign financial activity, forms that the vast majority of ordinary American seniors have never heard of, let alone received any guidance about filing, the entire account is queued or an extended federal review that can last weeks or months while the account remains restricted. And then there is the fifth trap, the newest one, the one that almost nobody sees coming because it involves something the senior themselves may never have touched, never owned, and in some cases may not even fully understand. Banking and tax compliance professionals are calling it the cryptocurrency adjacency flag. And as of 2026, it is one of the fastest growing sources of account flags affecting seniors who had absolutely no direct involvement in any cryptocurrency activity whatsoever. Here is how it works. As of the most recent regulatory updates, cryptocurrency exchanges operating in the United States are required to report every single transaction they process to the IRS, regardless of the dollar amount of the transaction, regardless of whether the transaction resulted in a profit or a loss, and regardless of whether the person making the transaction had any awareness that such reporting was occurring. Now, here is how the trap specifically closes on seniors. A very large number of seniors across this country share a joint checking account with an adult child, typically a son or a daughter who stepped in to help manage the household finances after the senior's spouse passed away, and whose name was added to the account for practical convenience and nothing more. If that adult child uses the joint account for any cryptocurrency related activity, even a single transaction involving only a few $100s, the exchange is legally required to report that transaction to the IRS. The automated monitoring system links the reported cryptocurrency activity to the joint account. The joint account is flagged, and the senior, who may never have touched cryptocurrency in their entire life, who may not own a smartphone capable of accessing a cryptocurrency exchange, who may not even know how to pronounce the word Bitcoin, who certainly never intended to become part of any federal monitoring process, suddenly finds their account placed under federal review with no warning and no explanation they can readily understand. Now, I want you to do something for me at this exact moment. I want you to pause whatever else you are thinking about and do one simple thing. When was the last time you actually looked at your checking account balance? Not the rough number you keep somewhere in the back of your mind. Not the figure from last month's paper statement that is sitting unopened on your kitchen counter. The actual, current, live balance as it stands today. If you have your phone or your computer within reach, I want you to open your banking app right now and look at the number on the screen. Because the number you are looking at may already be sitting inside one of these 5 trigger zones. And until this moment, you may have had no idea that you needed to worry about it. Do not feel embarrassed. Do not feel frightened. Simply look at the number and keep it in mind. Because what I am about to tell you next is the connection I promised you at the very beginning of this video. And you need to be giving this your complete attention when I explain it. When the federal monitoring system flags your account and that flag results in action, your bank does not always freeze the entire account balance outright and prevent all activity immediately. In many cases, what banks and compliance professionals describe as a soft hold is placed on the account. A soft hold is a specific type of restriction that prevents you from making new withdrawals or initiating outgoing transfers, while still allowing incoming deposits to continue arriving in the account on their normal schedule. Your Social Security payment arrives on its normal date. You can see the deposited amount displayed on your account screen in perfectly clear black numbers. The money is there. You can see it. You simply cannot touch it, cannot withdraw it, cannot transfer it, cannot use it for anything. And this is precisely where the connection to Medicare becomes genuinely devastating in a way that can affect your finances for the rest of your life. Your Medicare Part B premium, which in 2026 stands at $185 per month for most beneficiaries, is normally deducted automatically from your Social Security payment before that payment ever reaches your bank account. The deduction happens at the federal level before disbursement. Under normal circumstances, you never have to think about it, never have to write a check, never have to remember a due date. But when your account is placed under a soft hold and the payment mechanics are disrupted, that automatic deduction can fail. And when the automatic deduction fails, Medicare does not absorb the missed premium on your behalf while you work through the account dispute. Medicare does not receive a notification that you are in the middle of a banking issue and extend you a grace period out of common sense and decency. Instead, Medicare generates a direct billing notice, a plain white envelope with standard printed text. No bold warning, no red lettering, no label indicating that this is a time sensitive matter requiring your immediate response. It looks exactly like the kind of envelope most of us have learned over decades to set aside and open later, or in some cases, to set aside and accidentally forget entirely while dealing with a more pressing crisis. If you fail to notice that envelope in the chaos and confusion of trying to resolve a frozen bank account, and if you fail to pay the premium within the applicable grace period, your Medicare Part B coverage lapses. It simply stops. And when you eventually resolve the banking situation and attempt to re enroll in Medicare Part B, you discover that you are now subject to a permanent late enrollment penalty. 10% added to your monthly Part B premium for every 12-month period during which you are without coverage. That is not a temporary surcharge. That is not a penalty that phases out after a few years of on time payments. That penalty does not expire. That penalty does not diminish over time. That penalty does not go away when you appeal, because there is no successful appeal for a legitimate lapse in coverage. That penalty follows you in black and white on every Medicare bill you receive for every remaining month of your life. So, what is the safe amount to keep in a checking account in 2026? Here is the plain spoken, direct answer that your bank will never volunteer and that no financial advertisement on television will ever make clear to you. Your checking account was never designed to function as a long term savings vehicle. It was never intended to be the place where you store the accumulated wealth of a lifetime. Your checking account is a transit station. Money arrives, passes through briefly, and should leave on its way to a more appropriate destination. The general guidelines supported by certified financial planners who specialize in working with retirees is to maintain approximately 1 month of essential living expenses in your checking account at any given time, plus a modest buffer of $1,000 to $2,000 for unexpected small expenses. For most retirees, that works out to a target balance somewhere between $3,000 and $7,000 at any point in the month. Any amount significantly above that ceiling should be held elsewhere, in a high yield savings account, in a money market account, in a certificate of deposit, preferably at a separate financial institution from the one where you hold your primary checking account. Here is the specific protection plan, and I want you to visualize each of these steps happening at a real moment during your actual week, not as an abstract checklist you intend to get to someday. Tonight, after dinner, sit down at your kitchen table with something warm to drink and pull up the last 6 months of your checking account activity. Go through it deliberately and carefully. Identify any single deposit that stands out as meaningfully larger than your normal monthly deposit pattern. The proceeds from a car you sold, a settlement check that arrived last fall, an inheritance that was distributed after the passing of a loved one, a Fairness Act retroactive payment from the Social Security Administration. Whatever the source, find the paperwork that documents where that money came from. Put that documentation in one folder, clearly labeled, stored somewhere you can find it within 24 hours if your bank or a federal agency ever asks you to explain the deposit. That folder is your first line of defense against a monitoring flag that could otherwise escalate into a full account freeze. Tomorrow morning, if you received a Fairness Act retroactive payment at any point in 2025 or early 2026, call your tax preparer and ask them one direct question. Did the receipt of this payment require any additional reporting on my most recent return? Just that one question. Your tax preparer may tell you that no additional reporting was required, and you can move forward with complete confidence. Or they may identify something that needs to be addressed before the discrepancy flag creates a larger problem later in the year. Either outcome is worth the 5-minute phone call. This weekend, make time to either drive to a credit union you trust or open an online high yield savings account with a different financial institution than the one where you hold your primary checking account. Move your long term accumulated savings into that separate account. Not because you distrust your primary bank, not because you have done anything wrong, but because separation is protection. If your checking account is ever flagged and placed under a hold, the savings at a separate institution remain entirely accessible. You can still buy groceries, you can still fill your prescriptions, you can still pay your utility bills, while the situation at your primary bank is investigated and resolved, a process that can take weeks. The next time you need to make a large cash withdrawal for any legitimate personal purpose, take the full amount you need in a single transaction rather than splitting it across multiple days to keep each individual withdrawal at a more comfortable dollar amount. A single $9,000 cash withdrawal is completely legal, entirely transparent, and raises no flag whatsoever under current federal guidelines. 3 separate $3,000 withdrawals made across the span of 1 week, each timed to remain below a threshold, can be interpreted as a structured pattern under the federal law I described earlier in this video. Transparency in single large transactions protects you. Splitting those transactions out of convenience or discomfort destroys that protection. And finally, if you pay any individual in cash for regular services around your home, the person who maintains your lawn each week, the housekeeper who comes on Tuesdays, the part time caregiver who helps with transportation or household tasks, keep a written record of every single cash payment you make to that person. If your cumulative payments to any single individual exceed $600 in a calendar year, you may have a legal obligation to file a Form 1099 with the IRS reporting those payments. Ask your tax preparer the next time you see them. One form, filed correctly and on time, eliminates an entire category of potential compliance problems before they ever have the opportunity to materialize. And now, I want to bring you back to Eleanor Whitfield, the retired school teacher from Tampa, from the very beginning of this video. And I want to confess something to you that I held back from you on purpose, because I needed you to understand the full weight of the situation before I told you this. Eleanor is not one specific real person. Eleanor is a composite. She is a name and a face and a story I assembled from the documented experiences of thousands of real retirees scattered across this country. People whose accounts have been frozen, whose balances have been flagged, whose Medicare premiums have been permanently increased because of financial patterns they created without any knowledge that those patterns were being watched, being evaluated, and in some cases, being acted upon in ways that altered the course of their retirement entirely. The grandmother in Phoenix who deposited her Fairness Act retroactive payment into her checking account because she did not know where else to put it is a real person. The widow in Cleveland, whose joint account with her adult son was flagged because of cryptocurrency activity she had no knowledge of and no involvement in, is a real person. The retired firefighter in Georgia, whose 3 cash deposits from selling a recreational vehicle at a fair price triggered a structuring investigation that took 4 months to resolve, is a real person. Eleanor is every single one of them. She is the face of an experience that is not rare, that is not theoretical, and that is not going to become less common as automated federal monitoring systems become more sophisticated and their thresholds become more sensitive. Eleanor could be you. She could be your sister. She could be the woman who sits next to you at church every Sunday morning and has no idea that the balance she is carrying in her checking account right now, the balance she accumulated through 40 years of careful saving, is sitting inside a trigger zone. She will not know until the teller says those 7 words. One final warning before this video ends, and I want this warning to be the clearest, most direct thing I say to you today. This week, right now, scammers operating sophisticated telephone fraud schemes are calling seniors across this country and pretending to be agents of the Internal Revenue Service. They are telling those seniors that their bank accounts have been flagged by the federal monitoring system and that immediate action is required to avoid arrest, asset seizure, or criminal prosecution. They are using official sounding language, fake badge numbers, and threatening tones designed to create panic and override rational judgment. Every single one of those calls is a fraud. Every single one of those callers is a criminal attempting to steal from you using fear. The real Internal Revenue Service does not call taxpayers on the phone to deliver warnings about account monitoring. The real IRS does not send text messages. The real IRS does not send emails with links to click. Every legitimate communication from the Internal Revenue Service arrives at your mailing address, on paper, in an envelope, containing a formal notice, with a notice number printed clearly at the top of the page, a number you can independently verify by visiting irs.gov. If your telephone rings and the person on the other end of the line claims to represent the IRS, hang up the phone immediately without providing any information, without confirming your name, without saying anything that could be used against you. Then report the call to the Federal Trade Commission. If this video helped you understand something that your bank, your financial advisor, and your evening news program have never explained to you in plain, direct, honest language, please take 30 seconds to share it with one person you care about, particularly someone over the age of 65 who has been managing their finances the same way they always have, without any awareness that the rules of financial surveillance have changed dramatically in the past 18 months. One share could save a retiree from a frozen account, a missed Medicare billing notice, and a premium penalty that follows them on every healthcare bill for the rest of their life. And before you click away from this video, I am asking you to watch the very next video on this channel. Because what comes next is something every senior in America who has ever filed a tax return needs to know. Exactly what to do, step by step, word for word, if the IRS contacts you about your tax return after you have already filed it. The precise words you must say when an agent reaches out. The precise words you must never, under any circumstances, say in response to an IRS inquiry, whether it comes by letter, by phone, or by a knock on your front door. That complete word-for-word script is waiting for you in the next video. And I promise you, on my full reputation, that it may be the most important 15 minutes of information you absorb this entire year. Do not skip it.